Imagine being able to take a trip back in time to 1976 when a gallon of gasoline cost about 59 cents, a gallon of milk cost $1.42, and the median family income was around $15,000. Back in 1976, if you could have invested just $6 every single trading day into an S&P 500 stock index fund, what would that be worth today? Spoiler, it's an eye-opener and proves anyone can build wealth with patience and consistency. In this video, we're diving into this what-if scenario using real historical data. We'll cover the power of compounding and dollar-cost averaging, or DCA, where you invest a fixed amount regularly, regardless of where the market is heading. Just one quick note, this is an informative exercise and should not be taken as financial advice. As such, past results don't guarantee future performance. Please stick around until the end of this video to see the surprising final number. And if you enjoy this content, hit that subscribe button and bell for more investing insights. Without further delay, let's dive in. This hypothetical exercise assumes investing $6 every single trading day in the Vanguard 500 Index Fund Investor Shares, ticker symbol VFINX, starting with its inception on August 31st, 1976. VFINX was designed to track the S&P 500 index, which is a widely regarded benchmark of the health of the U.S. economy. It tracks the 500 largest public companies in the U.S., which at the moment includes NVIDIA, Apple, Microsoft, and Amazon, among many others. To really appreciate this investment journey, let's travel back in time, starting with the 1970s. The 1970s brought challenges with economic stagnation and high inflation, hence the term stagflation. The OPEC oil crisis of 1973 quadrupled gas prices, leading to shortages and recession, while Watergate shook political trust. Culturally, it was the era of disco fever, Star Wars, and environmental awareness with the first Earth Day. Markets struggled. The Vanguard 500 averaged just 1.07% annual returns, hit by 2 recessions and the Nifty 50 stock bubble bursting. Despite the slowdown, dollar-cost averaging would have helped by buying shares cheaply during dips. The 1980s roared back with Reaganomics, tax cuts, deregulation, and a focus on free markets. The end of the Cold War loomed with the Berlin Wall's fall, while tech like personal computers and MTV transformed culture. It was the decade of yuppies, Wall Street excess as depicted in movies like Wall Street, and brands rising to prominence. The Vanguard 500 delivered stellar 13.28% average annual returns in a prolonged bull market, though interrupted by the shocking 1987 Black Monday crash, where the index plunged over 20% in a single day. Your $6 investments would have multiplied rapidly here. The 1990s were defined by globalization, tech innovation, and prosperity under President Clinton. The internet revolutionized communication with the World Wide Web's rise, leading to the dot-com boom. Events like NAFTA expanded trade, while culture buzzed with grunge music, Friends on TV, and the Y2K scare. The Vanguard 500 soared with 18.43% average annual returns, fueled by tech stocks and low inflation, though the decade ended with early signs of the bubble that would burst soon after. This era highlighted how innovation drives market gains. The 2000s were tumultuous, starting with the dot-com bust that wiped out trillions in value. Then came the tragic 9/11 attacks, leading to wars in Afghanistan and Iraq, and a focus on security. The mid-decade housing boom, fueled by easy credit, ended in the 2008 financial crisis, the worst since the Great Depression, triggering global recession. Culturally, it was the rise of reality TV and social media's beginnings. The Vanguard 500 averaged a dismal negative 1.03% annual return for the decade, with 2 major bear markets, testing investors' resolve but rewarding those who kept investing through the lows. The 2010s focused on recovery and tech dominance. The Great Recession's aftermath saw stimulus and reforms like Obamacare, while Occupy Wall Street highlighted inequality. Tech giants like Apple, Amazon, and Facebook, now Meta, exploded, with smartphones and social media reshaping daily life. Under Presidents Obama and Trump, trade tensions arose, but the economy rebounded strongly. The Vanguard 500 averaged about 13.39% annual returns in one of the longest bull markets ever, driven by low interest rates and innovation. perfect for compounding your daily contributions. Finally, the 2020s so far have been defined by disruption and rapid change. The COVID-19 pandemic caused global lockdowns, massive stimulus, and a sharp market crash followed by a swift recovery. Remote work boomed via tools like Zoom, while AI advancements from companies like OpenAI and electric vehicles from Tesla signaled a tech revolution. Inflation spiked post-pandemic, leading to rate hikes, but the S&P has hit record highs around 1,600 points as of September 2025. Average Vanguard 500 returns have been volatile but impressive, around 14.4% annualized, emphasizing resilience amid uncertain times. Why $6 a day? In 1976, investing just $6 a day was equivalent to setting aside about 10% of the median family income of roughly $15,000, which is a savings rate still common today. With about 252 average trading days a year, that's over $74,000 invested over 49 plus years, spanning from August 31st, 1976 to September 2025. Combine this with the snowball effect of compounding, and that's where the magic happens. Let's now dive into the calculations. We're estimating dollar cost averaging from investing $6 every day into the VFINX index fund with dividends reinvested. Dividends are those quarterly shareholder payouts by certain companies and can contribute to supercharging growth. First, we calculate the total contributions over the 49-plus-year period, starting from the inception date of the VFINX fund on August 31st, 1976, and ending on September 19th, 2025. Assuming 252 average trading days per year, the total contributions equal $74,172. Next, since we're compounding daily versus annually, we need to convert the annualized return to a daily return. Using Vanguard's official annualized return for VFINX of 11.55 cents since inception, the average daily return rate is calculated as 0.0438%. Finally, the future value of all those contributions is calculated using the annuity future value formula to reveal the final value, which ends up being $2.933 million. After crunching the numbers based on Vanguard's historical annual return rate, a $74,172 total investment would grow to approximately $2.933 million by September 2025. That's right, almost 40 times growth due to compounding and dollar cost averaging. Let's break it down. The early years were rocky. The 1.07% return during the short 4-year span in the 1970s due to stagflation resulted in a slow start. But the 1980s rebound and the 1990s dot-com boom more than made up for this. Through crashes like 2000's dot-com bust and 2008's housing market bubble burst, dollar cost averaging allowed you to buy more shares when cheap during these tough times. Compared to a bank savings account with a rate of 1 to 2%, you'd only have amassed between $100,000 to $200,000. Nothing compared to this over the same period. So, what can we learn from this financial exercise? First, compounding is the real MVP. Albert Einstein called it the eighth wonder of the world. Your early dollars work hardest, growing exponentially over decades. Second, dollar cost averaging smooths the ride. No need to time the market, just stay consistent. During crashes, you snag bargains, and in booms, you ride the wave. Over 49 plus years, the S&P 500 has weathered wars, recessions, and pandemics, yet averaged double-digit returns. Our 6-out-a-day habit since 1976 would have grown into about $2.933 million today, and that's after all Vanguard fund fees. But keep in mind, inflation over those 49 years means a dollar in 1976 bought about 5.63 times as much as it does today. In real terms, the investment would feel more like $521,000 of 1976 purchasing power. Still, that's almost a 7-fold increase in real wealth compared to the $74,000 we put in. In addition, in order to realize the profits, one would need to pay federal and state capital gains taxes along with the net investment income tax, all of which can max out at up to 37% if you live in California. To wrap up, this financial exercise is proof that small, steady actions build fortunes. According to the legendary investor Warren Buffett, you don't get rich fast, you get rich slow. Calculate your own scenario. What if you start investing $10 a day now? Share your thoughts in the comments. If this inspired you, like, subscribe, and share with a friend dreaming of financial freedom. Thanks for watching, and until next time, happy investing.